Hey everyone, welcome to this video on ACE Investor series where we cover stocks that are part of portfolio of ACE investors of our country. If you are new to the series, we have already discussed a few stocks like Gravita India that is part of Mr. Ashish Kacholiya Portfolio. This stock has already jumped more than 50% in last few months since we covered it. Then we have also covered Little Champ portfolio of Mr. Saurabh Mukherjee. If you haven't watched this video, do check them in ACE Investor playlist. I've also shared the link in the description box. Now in today's video, I want to cover a company which is not just part of one ACE investor portfolio but two ACE investors have a good stake in the company. ACE investors are Mr. Ashish Kacholiya and Mukul Agarwal. The interesting part is Mr. Mukul Agarwal is holding stake in the company since last 6 quarters and Ashish Kacholiya is holding it since 4 quarters without any change in their shareholding. That suggests their confidence in the company. Well, company name is Shankara Building Products. It's a micro-cap company with a market cap of just 1600 crore, but it is one of the leading player in its niche. Basically, it is one of the India's leading organized retailer of home improvement and building products. Considering the fact that we are in early stage of upcycle in capex and construction activity, the demand for building products is going to surge big time and can potentially benefit Shankara Building Products. But there are a few risks in the business that you need to keep in mind. So as usual, we'll cover the business model of the company, its leadership, key strength, future growth prospect, financials, and key risk. Finally, we'll cover the valuation part. But before we begin, just a disclaimer that it is not a buy or sell call. It is just an initiative to spread knowledge. Please do your own research before investing your money. Alright, let's get started. Established in 1995, Shankara Building Product is one of India's leading organized retailer of home improvement and building products. It is a one-stop marketplace for entire home construction and renovation lifecycle that include construction materials like steel tubes, TMT, cement, etc. Then plumbing and sanitary ware like PVC pipes and fittings, water tanks, sanitary ware, solar heater. Then flooring includes ceramic tiles, vitrified tiles, wooden flooring. Then electrical segment offers electrical cable and fittings, switches, decorative lights, fans, heater. Then interior exterior segment include paints, roofing, wallpaper, plywood, kitchen, and irrigation include pumps, motors, sprinkler, drip lift irrigation, etc. Basically, company started its journey in 1995 as steel trading company, and then in 2008 it started its retail operation with one store in Bangalore. During this phase, it did multiple acquisition and even launched its in-house brands. Eventually, company got listed in 2017, and now in 2022, company has become an omni-channel market with both offline and online presence. Company has launched Build Pro app with 1 lakh plus SKU across building product lifecycle. Company is consistently expanding its product offering, adding luxury brands in the portfolio and launching its in-house brands. Company's product portfolio include top brands in each segment. You can see the brand names Prince, Utkarsh, ACC, Jaguar, Parryware, Kohler, Hindware, Havells, Crompton, Phenolics, Schindler, Kajaria, Serra, Philips, Tata Steel, Berger, APL Apollo, Supreme, Astral, then your Asian Paint, and the list goes on. Now broadly, their business offering can be divided into two segments, steel and non-steel. In FY23, company did a sale of around 4,029 crore, out of which around 3,667 crore is from steel segment and just 362 crore is from non-steel. So steel contribute more than 90% in company's revenue and non-steel has just around 9% business. But the interesting aspect is this non-steel business is now growing at rapid rate. In FY23, it has grown around 80%, and going forward, company intend to expand its non-steel business from 9% to 25% by 2028, which is a high margin business, and that would be one of the biggest growth driver for the company. We'll discuss it further in the future growth prospect. Now, as far as business model is concerned, companies into both B2B and B2C business that include homeowner, contractor, retailer, distributor, and industries. For instance, in Q1 of FY24, retail segment, that is people like you and me, contributed around 55% and non-retail segment contributed around 45%. So it's a nice spread. Some of its non-retail clients include L&T, Sobha, Brigade Group, Murugappa, KEC, Prestige, Tata Motors, etc. Company has a strong presence in South India with cluster-based distribution network in 10 states and 45 cities dominated by Karnataka, then Tamil Nadu and then Kerala. However, company is now growing in Maharashtra and Madhya Pradesh. Overall, company has around 125 brands in its portfolio with 91 retail store network, 21 warehouses, over 2,000 dealer network and widespread customer base from small homeowner to large developers. I hope you got a fair idea about the business of the company. As far as leadership is concerned, Mr. V. Ravichandar is the chairman of the company. He has done his bachelor's from BITS Pilani and master's from IIM Ahmedabad. He has been associated with the company since 2007 and has got more than 42 years of experience. Then Sukumar Srinivas is the MD of the company. He holds bachelor degree from Loyola College, Chennai and master's from IIM Ahmedabad. He has been associated with the company since inception and has around more than 39 years of experience in the building product industry. Overall, the leadership is looking highly experienced with top-notch education. Now let us look at the future growth prospects. Okay, before we discuss the future prospects, let's understand what has happened in the past. So Shankara Build Pro has its IPO in 2017 at rupees 460. It zoomed quickly to levels of around 2000, but then share price corrected significantly. And today, share is trading near 720 rupee. So net the share price is back to near its IPO levels. The biggest reason is company's underperformance in last few years. Company's revenue did grow during 2012 to 14, but growth became stagnant for next 5-6 years. Worst part was deterioration of margins from highs of 7% to 4% that resulted in sharp fall in operating margin. Profit before tax even fell down badly. So company's financials in the past were weak due to two key reasons. First is slowdown in demand for building material. And second is company's poor margin profile with operating margin falling to as low as 3%. And it was the key reason for underperformance in company's share price. However, post-COVID, there is a sharp improvement in demand for building material due to uptick in real estate sector across your residential and commercial sector. And second is government focus on infrastructure along with focus on housing for all. By the way, there's a great opportunity due to this upcycle in real estate sector, and there are few stocks where even I have invested my money. I've discussed them in my weekly video series available on my website, where I cover my investment strategy, portfolio detail, then macro trends, then quarterly results and many more things. In case you want to learn or explore the course, I provided the link in the pinned comment. Okay, coming back, due to this upcycle in real estate sector, last year company's revenues have grown 66% and net profits have grown 85%. Company's inventory days have also improved from 61 to 41 days and cash conversion cycle has improved from 62 to 37 days. Working capital days have improved from 63 to 39 days. ROC is also improved from 10% to 16%. Company's cash from operation has been consistently positive except for COVID year. Although the operating margins of the company are still very low at around 3%, but the margins are expected to improve because company is now focusing on high margin business of non-steel segment that currently contribute around 9% in total business, and company is planning to increase this contribution to 25% by 2028. Look at the total addressable market for the company. Sanitary ware 18,000 crore, tiles 45,000 crore, pipe segment 40,000 crore, then electrical 70,000 crore. And Shankara has negligible share in these segments. Basically, the margin for steel segment are around 3.5 to 4% and non-steel is around 10%. So as the exposure in non-steel segment would increase, it should also result in overall margin improvement. In case you are wondering why the margins are so low, the simple reason is because it's a retail company and margins in retail segment are always low. For instance, DMart also has around 8% margin. But the key here is inventory turnover and better working capital management. And company's inventory turnover has improved in FY23 and also working capital has improved. So this should boost company's profitability. Then another key growth driver is its omni-channel business strategy with the use of technology, where users can explore the product online and can purchase them offline from the stores. Overall, company has mentioned 4 key growth strategy for the future. First, expansion of non-steel business to 25% in next 4-5 years, which is a high margin business. Second, leveraging its distribution channel for cross-sell opportunity to existing and newer geography. Third, transforming ecosystem with technology. And fourth, strengthening balance sheet. Company's management has mentioned that they aspire to grow at 20 to 30% CAGR rate for the next 4-5 years and become a 10,000 crore top line company in the next 5 years. So basically going forward, company is expecting to grow its top line big time and also improvement in margin from 3% to 5%. This can result in EBITDA growing 4 to 5 times in the next 4-5 years. And if company can grow as per plan, it can certainly become a multi-bagger. Now let us look at the valuation part. So currently company is trading at around 720 rupee and commands a market cap of around 1600 crore with a PE ratio of 24. So valuation wise there's a lot of comfort. Its price to sale is just 0.38 and even EV to EBITDA is just 13. Now going forward, everything will boil down to the execution. If company can achieve its growth plan, it can certainly grow multifold times from current levels. And considering the upcycle in real estate and construction sector that should probably last for next 4-5 years, I'm not surprised why ACE investors Ashish Kacholiya and Mukul Agarwal have invested in the company. They want to ride this capex wave and Shankara looks like a good proxy for this segment. In terms of shareholding, promoters have around 52% stake. FI's stake has reduced significantly from 22% to 8%, although there is an increase in stake in last quarter. Then DIs have lower stake, but they have also consistently increased holding from 4.15% to 5.36%. Now public holding might look high and also there is an increase in public holding which is not considered a good sign. But if you look closely, there is institutional buying with APL Apollo buying 4.38% stake, then Mukul Agarwal invested in March 22 quarter, then Ashish Kacholiya invested in September 22 quarter. In fact, number of shareholders have actually reduced from 26,000 to now at 20,000. So don't just look at public holding, you need to deep dive. Now final part of this video is key risk. So first risk is fluctuation in material cost. Material like your steel, pipe, sanitary ware and other building product constitute more than 90% of company's total expense. Since the price of steel and other products are determined by supply and demand and various other factors, any adverse changes in the prices can impact Shankara Build Pro revenue and profits. Second risk is cyclicity of business. Please note that real estate demand is cyclical in nature. Although currently it is an upcycle, but in the long run, the business growth can be impacted by a slowdown in real estate activity as we have witnessed in the past. Then another risk is low profitability. Since company operate on very low margin, it's very important to manage the inventory and working capital efficiently. Any fall in inventory management and working capital management can negatively impact company's profitability. And fourth risk is competition risk. Building material is a highly fragmented market where the user decision is influenced by your architects, contractor and interior designer. So it's not easy to crack this highly fragmented market, but at the same time, it creates an opportunity. So in this video, we discussed the business model of Shankara Build Pro, where two ACE investors have shown their confidence. The biggest reason I could understand is due to tailwind in terms of uptick in real estate sector across residential and commercial sector. And second is government focus on infrastructure along with focus on housing for all. Company's management is aspiring growth of 20 to 30% CAGR for next 4-5 years and margins are also expected to expand due to focus on non-steel segment. Currently company has a very small market cap of around 1600 crore with a very attractive valuation at PE of 24. So overall it can be a great investment opportunity, but at the same time there are risks that you need to keep in mind before you take investment decision. Overall, from risk reward perspective, this company is looking attractive. I'll keep a close eye on company's quarterly result to track its progress. I don't want to stress this video further. Now let me know which other company from ACE Investor portfolio you want me to cover next. And if you find this video useful, do share it with your friends. And if you want to explore more videos in this ACE Investor series, I've added the link in the description. To stay informed about exciting investment opportunity, you can consider subscribing to this channel and click on the bell icon to get the update for the latest video. I'll see you next video. Till then, take care.